I mean, 20% on in a move in Tesla is quite a move. It made me think about our volatility rush and crush conversation. And so I know we're not going to go over Tesla, but what did you look at last week and implement, and what's our setup here?
Well, last week, if you remember, we had a user send us a candidate that he wanted us to take a look at during the speed round. That was Tyler from St. Paul, Minnesota. He wanted us to look at 3M, right? So that was ticker MMM. And what I had seen for Tyler was, hey, earnings was coming up this week, and that it looked like it was going to be a good candidate for earnings. And then at the end of last week's AJ Brown show, I said, hey, you know what? I'm going to go ahead and see if it's worth me to trade that. And if I do, I'm going to talk about it. So I did just that. And we used our horizontal calendar spreads type strategy. So just a quick reminder on calendar spreads, some of the characteristics of these things. First of all, any intrinsic value that's in the options that we use in the calendar spread is canceled out, because a calendar spread is where we buy a strike price with a different expiration date, and then we sell the same strike price, different expiration dates. That's why it's called a calendar or horizontal spread, is because it's the same strike price, different expiration date. And it's the strike price and its, relation to what the current price of the stock is that determines the in the money or intrinsic value. So if you're buying the same strike price that you're selling, the intrinsic value cancels out. The intrinsic value is also often terms, looked at as the real value or the value of the option when it expires. So you're not even factoring any of that intrinsic value into a calendar spread. What it is it's the difference of these extrinsic values or the emotional components of the option price. And if you look mathematically at the way this thing works, is it's got kind of a parabolic rise in price up into the strike price. And then if the underlying symbol goes out, and my drawings are not very good, but it's parallel on both sides. It's this parabolic run up and then a parabolic drop down in price. And what we really like about these trades is that they respond fantastically to changes in volatility. So if we use a front month option, that's the one with the closer expiration date, that's literally like days away. We could use a weekly option. And then we use an option that's a couple of months away. That couple of months option is going to remain fairly stable in price based on implied volatility changes, because people who are worried about earnings or thinking about earnings, they're going to hedge their trade with the near term or even the weekly options that are going to expire in a few days. So those are the ones that have the big extremes, right? As people buy them ahead of earnings because they want to make sure they hedge themselves, it causes their price to go up. We call that a volatility rush, right? And then as soon as earnings is released, we get a volatility crush, right? People start selling those options back. I don't need them anymore. I want my money back, or as much of my money back as I can get that I spent on that insurance. And so you see a volatility crush. And what's really nice about this calendar spread is that when you're seeing the volatility rush before earnings, it's a small price. And now I'm drawing the volatility crush. What happens after it crushes is this calendar spread jumps up in price. So we really like it for that reason, because we can take advantage of kind of the known component of an earnings play is that ahead of earnings, people get nervous and they buy insurance. So we get into the business of selling it to them at top dollar, right? And then after earnings, they want to sell that insurance back, and we're in the business of buying it for a lower price. And we make the difference, right? That's what the calendar spread's so good at. The caveat that we talked about last week and why we think 3M would be a good trade and Tesla maybe not so much is that these calendar spreads have a side effect in that they're very gamma influenced. Gamma is kind of the rate of change that they respond to the underlying symbol price change. In other words, we like the ones that have very little change during earnings, kind of like people get excited for no reason when earnings comes. The news is blah blah and very little stock price changes. It just goes on like it's another day and people sell back their insurance. They bought it, but they really never needed to use it, right? So we would prefer to not see very much price change. So with all that background said, here's what I did. We saw that, let me get rid of all this chicken scratch I put on my screen. We saw that earnings was going to be reported before market open, right?
And I have a quick question. Leading into the earnings, do you care if the stock goes up or down, or do you care that it's going to move exponentially?
So the scoop is with these particular horizontal trades, we can withstand a certain amount of movement up or down through earnings, right? But we would prefer for none, right? We would prefer that there be no, change in that price. We can have a little bit, but we don't want too much if we're using the calendar spread. If we think there is going to be a huge price change, then we'll default to a different option strategy like a straddle or a strangle. But for these SIP, we actually, so the intrinsic value, the in the money value cancels out. That's great. So that helps us a little bit. But what we're left with, even though it's so nice with the volatility, it's also got this weird gamma component to it. So we really don't want price to change too much. Does that make sense?
Kind of. And I guess we'll know as you go through the example. I was just kind of curious as to the setup leading into earnings, whether you want it to be good or bad or the movement, but it seems as if you kind of don't want much movement.
Well, and it really doesn't matter. I mean, we look at them, the way that we screen these is we look back at previous earnings, especially the one that was 1 year ago on the same date last year, and we kind of see how investors responded. We do a quick soft data analysis to see if there's anything in the news headlines that may cause earnings to be, unexpected. But if we can find a candidate, so we're just like in our premium selling, we're looking for boring ass stocks, right? Ones that aren't in the news, they're not the Teslas. I mean, look at 3M. We're talking Scotch tape. We're talking adhesives, right? Things that are boring, right? They just happen to be there. 3M, makes great products. They also make good money on those products. You can see that they always report positive earnings. They even give a heavy dividend back to their investors. So, you want these stocks that are good companies that are actually quite boring and not in the news headlines very often, right? So what I did was the day before earnings, and so that was on October 21st. I waited till the end of the day. It was well into professional hour. Actually, I got the details right here in my notes. I did one of the trades at 2:54 Eastern time, so right like 6 minutes before professional hour. Professional hour is that last hour of trading. The other one was 3:01 p.m. In fact, maybe I can put this up on the screen so people can actually see what I did. Let me see if I can copy and paste this into a text document for you guys. I wound up doing the December back month option, so the third Friday of December, and the front month option was literally this Friday, October 25th, today. So the trades that I did, I'm going to copy and paste this whole little area here. You guys will see exactly what I did. It's kind of fun because I took a couple of, we had that guest speaker a couple weeks ago, Dan Passarelli. And then he did a private webinar for anybody who wanted to register for it. That's the webinar you put at the top of the link SIP. And so he gave me a heads up during that webinar. He said, if you have a bias in direction, pick the strike price of your option combo that's in the direction of the bias. And if you don't have a bias, then pick the either strike price right around the where the stock is currently trading, and use your puts in the down direction one and the calls in the up direction one. Well, we were trading right around 135. We were trading at 134.40. Excuse me. And so I just did the 135, but I did take his heed, and I did a put calendar spread and I did a call calendar spread. I used the same options in both, except they were puts versus calls. And you can see here, and I did them equally. I'm not going to talk about the number of contracts I did because I just want to show you the per share price. For the one I bought at $2.54, I paid $1.72 per option, or $172 per contract. And on the other side of the equation, $1.98 per option, or $198 per contract, right? And so I bought quite a few of these contracts of both the put calendar spread and the call calendar spread, literally the hour before the end of the market on October 21st. Then earnings came the morning of October 22nd before the market opened. And what I did, and this is the key thing, and this is what I got from Dan, is I set up to have my trades triggered roughly at the same price that the stock was when it was, and some of these trades were going fast. You can see here that even though I programmed my automatic trading to say, place the order when the underlying stock is at 134.40, you can see that some of the trades got in, and that's just the nature of the beast. When you use these automatic bots, these automatic conditional trades, you say, okay, trigger the trade at 134.40. So your calendar spread goes down to the trading floor when the underlying symbol is at 134.40. Where it gets filled might be slightly different. So when I looked at it, it looks like my put calendar spread got filled when the underlying symbol was at 131.79, and my call calendar spread got filled when it was at 134.54. Suffice it to say, check out the returns. So this thing that I bought for $1.72, not even 24 hours later, more like 16 hours later, $3.79 per share. And the other one, $1.98, $3.65. All to say, I more than doubled my money in like less than 18 hours, right? I was so impressed, Sip. It worked exactly like Dan had said. It worked like a charm. And I wasn't even in here trading. I programmed these conditional trade details the night before. So kudos to Dan for optimizing my earnings play trades. But that was really a winner.
Yeah, and it's a strategy that we've been talking about
have
during earnings season, right? Because things are a little bit volatile, and maybe investors or traders are a little bit more eager to try and get in on any of the movement. But and so I guess, aside from the simple premium selling, the more simplified premium selling, longer term stuff that you kind of teach and educate, this is really, for some of the more active, trigger happy, that maybe still has those risk reward parameters that you like to implement into a lot of your strategies.
Yeah, absolutely. We modeled it out and determined exactly how many contracts I should be buying based on the size of my portfolio and based on the risk of these trades. But the cool thing is, you think about earnings, and you think about Tesla before yesterday's earnings result. And did anybody know, first of all, what they were going to report? Not unless you had insider information, which is illegal, right? So you didn't know which way Tesla was going to go. And also, more important, you didn't know how the investors were going to respond. So, and that's the same for pretty much any company. You don't know whether or not the stock is going to go up in price because of earnings or whether the stock is going to go down in price because of earnings. But it turns out that unless the company is really a popular company that gets a lot of news headlines, things like that, for the most part, and we can use some examination and some tools, a lot of the stocks that go through earnings have minimal, they minimally change in price post and pre earnings, right? Unless they have a lot of eyes on them and, a lot of investors in there that can get caught up in buying and selling. A lot of the plays are like 3M, where there's very little, aggregate price action. And so those are the ones that are best for this trade, because even though we don't know what's going to happen with the stock price pre and post earnings, what we do know, and what is pretty much always a given with these stocks, is that ahead of it, people are going to be buying near-term options to hedge their bet, driving that price of that option up. That's the volatility rush. And then right after earnings, literally seconds after the market opens the next day, the options market, they're selling those things back, and that's the volatility crush. And that's a pattern that we can take to the bank. The volatility rush the day before earnings and the volatility crush the day after earnings. And so, like I said, for the most part, most of the trades that we're going to be doing on this through earnings are going to be these calendar spreads. And if you want, every once in a while, if you've got like a Tesla, then you would use a straddle or strangle, one that's going to have a huge price change. But for the majority of these setups, these calendar spreads work like, they work like fire. They're just fire.